Thank you for having me here today, and thank you for joining us today. I'm absolutely delighted to give this talk today to an audience of economics teachers. On a personal note, I have two children in senior high school, and one of them does economics. And I'm in absolute awe of all of you because I really couldn't handle a few dozen of them. So let me turn to today's talk. I'm just going to share the screen, which hopefully works now. So the past 2 years have been out of the ordinary for everyone in both private lives and daily work routine, and this particularly includes teachers. It has also been out of the ordinary for the bank and for my department, domestic markets. And today I will talk about unconventional monetary policy. I will walk you through today's journey. What does monetary policy try to achieve? Which conventional and unconventional tools do we have? How do they work and how are they implemented? And then also, have they been successful? And I will illustrate as we go along with the example of the RBA's policy packages implemented in 2020. So let me turn to the objectives of monetary policy. Full employment, the stability of the currency and the welfare of the Australian people. That is what is really on the marble stone if you come into the Reserve Bank. Of course, practically, that is implemented nowadays in most advanced central banks as meaning to manage inflation. The Reserve Bank has an inflation target to manage inflation on average over the cycle. And in terms of employment, it is to smooth activity through the business cycle. So that really means you manage the full employment target while also managing inflation. Now let's think ourselves back into the situation in March 2020 as an example. Back then, we expected a sharp decline in employment and in inflation because we knew that in order to manage the health pandemic, we had to impose economic restrictions on movement. So in a situation like that, where you expect a sharp decline in employment, a sharp rise in the unemployment rate, and a decline in inflation, this is a case for significant demand stimulus, not only by monetary policy, but also by fiscal policy. So back in 2020, in March 2020, and also later in November 2020, the RBA implemented a package of policy measures. This package included both conventional and unconventional tools. The conventional tool is the cash rate, and we reduced the cash rate target. And the unconventional tools are forward guidance, explicit forward guidance. I'll go through all that in detail in a moment. A yield target for 3-year Australian government bonds and a bond purchase program. We also implemented a term funding facility for the banks. There was also more, but I singled out these really because these are unconventional policy tools that we've also seen other central banks use, not only in the most recent episode, but also before then. So how do these tools work? Well, let's look first at the conventional tool. The conventional tool for most central banks is a short-term interest rate. In our case, it's the cash rate. The cash rate is an interest rate overnight between banks. And by moving that interest rate up and down, they dampen the business cycle. And you can see that here in the past, how we moved the cash rate target, where you see, for example, during the GFC, we cut the cash rate also by a large amount, more than 300 basis points. So how does this cash rate work? I'll give you a brief overview. In principle, when the cash rate goes up, activity declines and inflation declines. And likewise, when the cash rate declines, this stimulates activity and inflation will also increase. So here you see a diagram of how that transmission passes through, and I will walk you through that. So the blue bit that you see is how the interest rate component works, and that's where the starting point is. So the cash rate, as I said, is a short-term market rate. It's the unsecured overnight interest rate between banks. So when one bank lends to another bank money just overnight, that gets recorded in the cash market. And that is one of the transactions that get measured in the cash rate. But of course, that's the shortest one. And if you move that, it affects other short-term interest rates in the market. In Australia in particular, the bank bill swap rate is a really important short-term interest rate, the 3 months rate for Australian banks. It affects the funding costs of the banks directly. In turn, for example, if the cash rate goes down, that means the bank bill swap rate will go down with it. The cash rate is the risk-free rate underlying that in the short end. That will lower the funding costs of the banks, and that in turn will lower the rates. The banks can lower the rates that borrowers face, such as mortgages or business loans, and will also lower the rates that savers get on their deposits. The largest part of funding for our banks are in fact deposits. So when these rates move, and now we move into the green segment of the picture, these affect consumption and investment decisions by households. And you can see that here in the middle, they are components of the GDP. And they do that through a variety of channels. There's the saving and investment trade-off. Low interest rates means that it's a little bit less profitable to save, a little bit more to consume now, but it also means it's a little bit cheaper for companies to invest. It affects the cash flow. Anyone who has a variable rate mortgage, for example, will face low interest rate payments and therefore have a little bit more cash available for consumption or other decisions. And it also has an effect on asset prices as well and wealth. So lower interest rates, all other things equal, would lead to higher asset prices. And that, of course, also affects the wealth overall and what people are willing, what other decisions they're willing to make in the consumption and investment space. And finally, there's the exchange rate. A lower interest rate, all other things equal, means that the exchange rate will depreciate. Also, that will stimulate economic activity. So all these channels will stimulate economic activity, as you can see in that green panel, and that in turn will affect inflation. So lower activity would mean lower inflation, or in the cash rate cut, it is higher activity that will lead to higher inflation. Finally, you can see at the very bottom that green line, that is inflation expectations. And they sit underneath that because inflation expectations are an important determinant for longer run inflation. And that feeds back into nominal interest rates. So that is really a textbook example of what the pass-through of interest rates are and why central banks use that interest rate lever. So having gone from the conventional tool, now what does the unconventional tool tell us? How do these work? So as I mentioned, there was the forward guidance, the yield target, and the bond purchase program. Well, they're actually not that unconventional when it comes to how they actually work and affect the economy, because they work through the interest rate. So quite similar channels to what I've just shown at the cash rate. But they work at different parts of the term structure of the interest rates, but they work all through the risk-free rates. So I want to step back and show you a yield curve here and just talk a little bit about it, because that's an important concept to understand, to then see how those various tools hang together when we implement them. The yield curve here is really the risk-free rate along different terms to maturity. The yield is a return on a bond, for example. It's a marketable interest. So think of it as a loan that can be traded in a market, and then it has a price there. That's really a bond. And when we talk about the risk-free curve, which is this one here, we talk about government bonds. And that is because we think it's highly unlikely that governments will ever fail on it. And so that determines the whole risk-free curve. So we got the cash rate at the very short end, and then we got bonds typically of different terms to maturity along the yield curve as far as 30-year. And the yield curve is upward sloping when the loan is for longer. When the loan is for longer than the cash rate, the yield is the rate of return on the price that you pay today. And the rate of return you get on such a bond are the fixed interest payment streams and the face value. And one of the important features that you need to know about the yield curve is really that Expectations of the cash rate over the horizon. So for example, for in 1 year's time, matter for the price today, because these yield curves are instruments that span that entire horizon. When the yield goes up, prices go down, and they move up or down with the cash rate, but they move also up and down with other things. What's the most important thing for you to know about this yield curve or the risk-free curve is it underpins all other interest rates. So other interest rates are typically the risk-free rate plus, say, a credit premium. So let's have a look at how the cash rate looks like in that context. Well, if you move a cash rate up, for example, it will move the yield curve up and down because a higher cash rate today means also usually a higher cash rate in future. And so investors expect a higher yield at all times. And likewise, a lower cash rate, which is what we did in 2020, means that the yield curve as a whole moves down a little bit. More so at the shorter end, because you give them there's a little bit more certainty on expectations of the near-term cash rates. So that is really how the conventional channel, or how we implement the conventional cash rate, how it affects that interest structure that was at the very left-hand side of the figure I showed you earlier. Now, what about forward guidance? So forward guidance is really talking about an explicit expectation of the cash rate or of the policy rate over a certain period, such as we think really conditions are in a state that the cash rate will remain low for a significant period of time. Sometimes it is spelled out for how long, sometimes it is just made as a conditional statement. That is what is forward guidance. And what happens then is it affects the expectation for the cash rate over that period, and it flattens that curve at that front end. That's what forward guidance does. Now, let's look at asset purchases, and we have done two types of asset purchases. This here is one where the focus of it is a price, and that was the yield target. Now, the yield target said that we would like, or we will aim to have the target of the 3-year bond yield at a very low level. It was actually aligned with the cash rate. And as you can see in this chart here, it means that the yield curve flattens in those front 3 years, and the rest kind of comes down a little bit, but it kind of gently goes upward sloping as well. Again, we have affected that whole risk-free curve, but you can see it's been a bit flattened relative to what a simple cash rate move would have done. The next one is when we purchase a certain quantity of those bonds, of those government bonds, and that is the bond purchase program that we've done. And that's really what we typically think of when we talk about quantitative easing. That really, again, lowers the whole curve where those purchases are. In our case, they were between 5 and 10 years. In this graph here, it's probably the whole yield curve. So where you are buying those bonds, the span of the purchase program is where you would expect the yield curve to decline. And the reason that is of course, there's additional demand for a given supply. That means the price goes up, the yields will go down. So they lower the risk-free curve across the curve. So all these tools that we've seen, and here I've put them all up again, all these tools, as you can see here, lower the risk-free curve. And so all interest rates at those maturities where the risk-free rate is lower. Now, I mentioned another unconventional tool, which was the term funding facility. That is really was a facility for the banking system that was 3 years funding to the bank at a very low fixed rates. And we made additional funds available if they increase business lending, especially small and medium-sized businesses. This doesn't work through the risk-free curve, but it works through bank funding costs, and then affects the borrower's rates. So the rates such as mortgages, or in this case, it was actually a focus on business lending, which is also businesses who are taking out loans. So because it lowers bank funding costs, we would expect the banks to be able to pass that on to borrowers. And that is how these funding facilities tend to work. So how do we implement those tools? Well, let's turn first to the cash rate. And the cash rate got, you can see that here in the graph, as low as 10 basis points. So the cash rate is implemented, the target that the Reserve Bank Board gives us, through a corridor. And that corridor enacts in the cash market. The cash rate, as you can see here, is where demand meets supply every evening. That is the clearing price of that. The quantity that is being traded in that market, or that's available, the supply that is available in the market, are exchange settlement balances. Think of those that this is electronic money that the banks hold with the Reserve Bank. And when one bank pays another bank, or the customer of one bank pays a customer of another bank, what simply happens is that the banks move the money in that exchange settlement account with the Reserve Bank from one account to the other account. So this is a closed system. The floor of that corridor is the RBA deposit rate. It is the remuneration that the Reserve Bank pays to the financial institutions on deposits they hold with us. For a bank to want to transact in the cash market, it wants to have an interest rate that is higher than the deposit rate it gets from the Reserve Bank. Now, think of the ceiling. The ceiling is a lending rate the Reserve Bank has, which is if a bank at the end of the day is in need of funds because it's run out of funds, it can come to us and we will give them an overnight loan. These are all collateralized, so overnight repo, so it's just for overnight, but we will charge them a markup, and that's the ceiling of that corridor. That's the RBA lending rate. So for a lender to borrow in the cash market, they will want to have an interest rate that is below the one they would have to pay to the Reserve Bank. The supply is fixed, and the Reserve Bank can control the supply, and we typically have done that in the past with open market operations. But there's a whole lot of other factors as well that can move the supply of exchange settlement balances around, and we typically would use open market operations to keep them at the level that we would like them to be. So we kept supply in the past such that the cash rate trades close to the target, and that is how it traditionally has worked. Now, I want to show you this one because this is actually what we did in 2020. We knew that the exchange settlement balances would go up a lot, and that would also mean significant cost to the bank because they would have to hold these closed system exchange settlement balances at those low rates that we had. So what we at the floor of the RBA deposit rate, at floor of the corridor. So what we did early on is we narrowed the lower part of the corridor to 10 basis points from 25. And in the event by November 2020, we actually lowered the whole system that you can see here to as low as the cash rate at 10 basis points and the remuneration on ES balances on 0. Now, when you find yourself that your cash rate is so low, that is typically, and you need more stimulus, that is typically when you consider other unconventional tools to inject further stimulus in the economy. So let's turn to those unconventional tools and see how we implement them. So how do we implement forward guidance? Well, as I said earlier, it's explicit longer-term guidance on a low cash rate. It's typically conditional on achieving the objectives. And in March 2020, we thought that it would take us at least 3 years to achieve those objectives. And therefore, we had given guidance out for that frame, saying that is conditional on achieving the objectives, but we think that it would actually be taking as long as 2024. So you use for implementing forward guidance really words and that explicit time or state guidance that you have. But then you also reinforce it with the other tools that we have, in some sense, put the money where the mouth is. So how did we implement the yield target? Well, the yield target was a price target or a yield target for 3-year Australian government bonds. The reason the 3 years was an appealing number is, first of all, it aligned with the forward guidance, but also a lot of borrowing and lending is done at terms of up to 3 years. We have a lot of floating rates, mortgages in Australia, but a lot of the bonds issued, particularly by banks, get issued at terms of 3 to 5 years. So we also knew that these 3 years would actually capture the interest rates on a lot of activity, a lot of lending activity, lending and borrowing activity. In order to implement the yield target, we bought bonds as required to achieve the yield target. So we didn't have a fixed program, but we said we'll look at the yield, and when the yield is not consistent with the yield target, we will go in the market and buy it. We bought in the secondary market. Now, the primary market for bonds is the issuance market. When you buy in the primary market, you buy directly from the government as it's issuing bonds. The secondary market is when you buy from an investor. So you buy secondhand, so to say. And the advantage of that is you don't finance the government directly, which is what central banks don't really do. But the aim was also to influence risk-free rates in the economy, and these are determined in the secondary market. That yield curve I showed you initially, that really comes from secondary market transactions. And that's really why we did all of our bond purchases in the secondary market. When we bought them, we would usually buy them with an auction. We would go up for a fixed amount, and then we would have a competitive auction with a market platform where anyone who's basically registered, these are financial institutions, can offer to sell us bonds. The result of those is that we increased holdings that the Reserve Bank has, and that means that yields are lower for longer. I'll get to that in the bond purchase program. But also, we would pay for these purchases by creating ES balances, and that would increase system liquidity and therefore put further pressure onto short-term market rates. So how do we implement the bond purchase in the bond purchase program? Well, quite similar to what I just described for the yield target. We bought a set quantity, though, of bonds in this case at a scheduled regular pace. We bought them in the secondary market, and we bought them through auctions. But the auctions were 3 times per week. We bought 3 to 10 years maturity, and we bought government bonds for both the central government and the state governments. So there's a couple of channels through which you affect yields when you run a program like that, but the most important one is the signaling and the portfolio rebalancing channel. The signaling channel is really what you signal for future monetary policy, and it's a little bit what I said, you put your money where your mouth is. So you signal, that you think the cash rate is going to be lower for longer. But the portfolio rebalancing channel is another one through which you lower yields, whereby there's an investor, and that investor has just sold bonds to us, and that investor is now going to go out in the market and actually buy another asset with that, and that will lower the interest rates further there, and that's the portfolio balance rebalancing channel. What's important to know when we're buying bonds is it's the total expected purchases matter. So that yield curve I showed you earlier, it depends a lot on expectations for the future, and they get priced in immediately. And so when we announce a bond purchase program with a known quantity, the effect of the entire program is actually priced into yields when we announce it, rather than when we conduct the purchases and follow through with that announcement. If we, though, wouldn't conduct the purchases, that would then reverse the yield, some of that initial yield impact. So, like with a yield target, where do we result? What's the result of that? Well, the Reserve Bank has higher bond holdings. These would lead to lower yields, all other things equal, because there's less supply in the market. And what's important to know is that the stock matters, not the flow for that, because we're taking these bonds out of the market, so to say. There is lower supply in that market for the other investors, all other things equal. And we also increase system liquidity because we pay for these bonds by increasing or crediting ES balances. And finally, how did we implement the term funding facility? We undertook collateralized loans. The lawyers don't call them loans, but you can think of it as loans that are collateralized, and these are so-called repos with banks. Now, why do we do repos? We conduct those kind of activities where we inject liquidity almost for a temporary period of time, almost always collateralized. And that's because central banks usually want a security in exchange for a loan. After all, it is the taxpayers' money that we're using here ultimately. So this transaction where you get a security in exchange is called a repo. There's a first leg to it where at the same time as the Reserve Bank gets the collateral, these are typically bonds, a type of bonds that are being given to us as collateral. At the same time as we get the collateral, we will credit the exchange settlement account of that institution we're dealing with. And then we have arranged that this whole transaction unwinds sometime in the future. And for the TFF, that is in 3 years' time. So at that fixed second leg that is agreed on at the beginning, this will unwind. We will get the ES balances back, and the financial entity will get the collateral back. Now, for the term funding facility, the interest rate on that loan or on that repo was a fixed interest rate. And at a very low rate, it was 25 and then 10 basis points. And it was for 3 years. The banks had an allowance, and that allowance was initially had a fixed part, but it was also increasing if the bank did new additional business lending. In this case, the banks choose when and what to draw down. So we give them an allowance. The condition is what the conditions of the repo are, but the banks could come to us and choose when they want to draw down and how much. Again, here we have collateral that ends up on our balance sheet, and we increase system liquidity because we credit the exchange settlement accounts for that. So did these tools work? Well, let's go to the conventional one where there's the cash rate. And now remember, I told you we also lowered that corridor a little bit. So what you can see here is that prior to 2020, the cash rate in red and the cash rate target in blue were actually almost identical. We had the cash rate trading at the cash rate target pretty much all the time, or very close to it. In the dotted black line is the floor of the corridor. So that is the remuneration on exchange settlement balances held with the Reserve Bank. And what you see here is that starting in the June quarter of 2020, when we started to increase exchange system liquidity, so exchange settlement balances in the system a lot, what actually happened is that the cash rate no longer traded at the middle of that corridor, but increasingly drifted lower towards the floor. But it didn't quite trade at the floor because, as I explained earlier, for someone to lend in the market, they will want to have a slightly higher interest rate. And you can see that we have seen since been in that lower half of the corridor, but we still have a corridor system. Now, the target bond yield, how did that work? How did the yield target work? You can see here that the target bond yield in red is in line with the target for much of 2020 and 21. Only in late 21, it was discontinued as the economic conditions improved a lot, and it was considered by the board that it was no longer appropriate. The yellow little vertical bars show you actually our purchases. In total, we purchased around $30 billion of yield target bonds. And you can see here, though, that there has been sporadic. There have been periods, long periods, where we didn't have to purchase any, and the yield target was actually, the yield was consistent with the yield target. Turning to the bond purchase program, the quantity program, you can see here that our holdings as a share of total bonds outstanding increased sharply. And that's the blue line here. It's now much more in line with what other central banks are holding, who have been often doing QE for a much longer period. The evidence how it's worked is a little bit more difficult to show on a simple graph, as longer term yields will move with other things as well, and not just the central bank purchases. However, our analysis shows that the yields were lower than they would have otherwise been, and that much of that impact has come up front. In total, we purchased around 280 billion of bonds under the bond purchase program. Finally, moving to the term funding facility, you can see that the rate of the term funding facility was significantly below what banks would have paid for bonds that they issued for the same funding. And that means that they had lower funding costs, and we could see that they have actually passed on the lowering of the funding costs through all of these measures to household and business lending rates. We had an extremely high uptake of the term funding facility, as well, around 188 billion in total. And as I said, with all of these steps, we credited system liquidity. And so it's not surprising that our exchange settlement balances have increased a lot over that period. From initially a size of about 2 to 3 billion before March 2020, you can see here that it ratcheted up, and it has been hovering in the last few months, just over 400 billion. And of course, what matters most is for the pass-through of monetary policy, the lending rates for household and businesses. That's really the nexus between the interest rates and the consumer and business decisions. And as you can see on this graph here, both housing and business, the outstanding lending rates on housing and business loans are at all-time lows. So I talked you through that and how the implementation works. So let me round out with what happened as the economic outlook improved. Well, you know that the economic outlook improved quite rapidly through 2021 as it became evident that there were effective vaccines and vaccinations were rolled out, and the economic restrictions were wound back. So in November 2021, the board decided to discontinue the yield target for 3-year Australian government bonds. The bond purchase program, we had no new purchases since February 2022. However, you should note that the overall holdings of 350 billion are still on our balance sheet. And because actually the holdings matter, because that is supply that is not currently in the bond market, that impact, that stimulus is still there, will gradually decline over the next 10 years because we bought bonds after 10 years. The term funding facility was closed to new loans in June 21. These repos or loans are still outstanding until June 24. Some of them will roll off in September 23 and some of them in June 24. But also that funding is going to be available for another little while to the banks and will also still exert stimulus in the economy for a number of years. Likewise, the ES balances will only be unwound as the effect of these policies unwind. In terms of our own operations, because of the large amount of system liquidity in there, we do not need to do daily operations anymore, liquidity operations, because we are no longer targeting a specific amount at the end of each day to keep the cash rate at target. But we have our liquidity operations now weekly, and they are at fixed rates. And they're small amounts. These are really just some entities that aren't as well connected. So that was what happened through the latter half of last year. So where are we now? These are the forecasts from the Statement of Monetary Policy that was just released. You can see here that the employment forecasts have come down a lot, where we had initially an unemployment rate of 7, over that period of steady above expectation improvement, and we're forecasting now the unemployment rate to be below 4%. On the other hand, inflation has been picking up. And on top of just the economic outlook, we've had a lot of supply shocks adding to that pressure on inflation. So faced with an outlook like that, the Reserve Bank Board decided to increase the cash rate in May. And the governor indicated that there are more rate rises to come in coming months. But you might wonder, with all those ES balances in the system, and you still have all these bonds on your balance sheet and the term funding facility, how did you raise the cash rate back in May? Well, the answer is we did what we always do. We lifted the cash rate corridor as usual. And while the cash rate is trading now in the lower half of the corridor, and why the ES balances are so large, they still moved up proportionately as we adjusted the corridor as usual. So we can still use the primary tool, which is the cash rate, in order to remove some of the stimulus of the overall monetary policy settings. So I hope I have been able to clarify today some of the questions on monetary policy that will help you in the important work that you as teachers are doing. And I will be very pleased if I have achieved that aim.